guys, Brian Stevens over here with Mortgage Shots and Capital Direct. Wanted to have a conversation today about why the real estate market is going to change, and it's going to start changing drastically, and why I believe that we've kind of run across something that, frankly, nobody else in the country is talking about. Sorry about that. Listen, everybody's had kind of a rough time in real estate and mortgage lending the past couple of years, and I think part of the problem, especially for mortgage loan officers, is we're coming off of the greatest refi market that we've ever seen, and then we hit the skids. It's almost kind of cruel to do that, isn't it? But there's a number of things that are taking place in the market that I don't think, again, anybody's really looked at that I want to share with you that gives me compelling reasons to believe that things are actually changing right now and are going to continue to change and go in the right direction, and it's going to allow us to build a mortgage origination business in a way that we haven't done before. And again, I hopefully this gives you a little insight into how the markets work and how it could benefit you. Now, one of the things that I do over at Cap Direct, we are a pure mortgage brokerages, is we are really looking closely at markets. We're understanding how a loan officer and a real estate agent, as teams working together, have to pivot in order to make the right decisions for their business. What's the shortest distance between us and the success that we're looking for? And so if you'd like to have a conversation with me about Cap Direct, what we're doing, and how you can really get in front of the bell curve in terms of the changes that are currently taking place and will continue to permanently and totally transform the mortgage and real estate landscape, reach out to us. I love our team. I love our crowdsourcing. I love how we're approaching our business, and we're looking for great loan officers who want to be a part of it. So again, send me an instant message and I'll have a private conversation with you. But let's jump into this. Now, the first thing that I want to bring up to you, is it changing? Well, of course, it's changing right before our eyes. We know today, we just got numbers from the National Association of Realtors, and sales on properties are up. They actually beat expectations. So this is the first time we've actually had good news in terms of what our production is on existing home sales. Again, the numbers beat the streets. They're going in the right direction. And of course, we had to eventually get here because we've been flat dead on the mat for the past number of months. So when we ever see these massive fluctuations in the market, we have hit lows and we're hitting superlatives, things we've never heard before. The most, the best, the worst, the least, that type of stuff. We had the least amount of sales ever in recorded history. Now, with our growing inventory, and it continues to grow before our eyes, we're seeing a number of things. Again, properties are starting to sit longer in most major metropolitan areas across the country where they haven't been doing that before. The average time listing right now in a lot of markets is north of 90 days, and concessions are being given by sellers. This is all going to help mortgage loan originators and real estate agents realize their potential. You see, because as rates are dropping, and they are, according to the FHFA, mortgage interest rates are going to continue to drop for the next 2 years. Now, the FHFA is who has conservatorship over Fannie Mae and Freddie Mac. This is wildly important because Fannie Mae and Freddie Mac combined are the largest, most profitable company in the history of the world. This is bigger than Apple, bigger than Exxon, bigger than all the stuff that Elon Musk is doing. They're massive. So the governing agency who has them in conservatorship, the FHFA, they have access to, first of all, the GSEs, Fannie and Freddie, who control a $7 trillion book of business. They've got the Treasury on speed dial. They got the Fed Reserve on speed dial. They've got the House Financial Services Committee, the Senate Banking Committee, the White House, everybody, and the best economists that the world has known, educated at the greatest schools in the world. So if anybody's going to know what interest rates are doing, you think it would be the FHFA. They're the big guy on the block type of thing. And right now, the FHFA is saying interest rates are going to continue their slide down for the 24-25 years, 2024-2025, the 2 years in front of us. So where we see rates right now, we're kind of happy with this, but we should be seeing a steady and gradual decrease in interest rates. Of course, that's going to bring affordability back. The fact that we have more inventory now than we've had in the past means that our consumers have more choices on their properties, and they can pick and choose the price, and this is going to really kind of take the momentum and move it over to a buyer side market. When that happens, sellers are going to be forced to drop their sales price and offer concessions, which we're seeing right now, and that is going to help you both in terms of your ratios with interest rates, with concessions, and with sales prices. So all of this is an absolute positive because for loan officers, a lot of those folks that you had pre-qualified in years past who've basically been priced out of the market, your ratios simply don't work, well, they might be coming back to you, so you're going to want to dust off some of those originations and get them back into the mortgage buying business. Another component that nobody's really talking about right now is that cash investors are falling by the wayside. Just a couple short months ago, we were sitting at almost 70% of all investors for cash offers on properties. And did you know that cash offers are basically getting 10% less across the board on sales price than those who are actually taking out loans? Of course, a cash offer is leaving loan officers on the outside looking in to where we don't have an opportunity to write a loan because those folks don't need to borrow somebody else's money. That number is down right now to about 64%. We've seen a significant drop, a full 6% drop in terms of cash investors coming to the table. Now, not only is it our cash investors who are taking up, but more importantly, it's our mom and pop investor out there who are looking at doubling or tripling their real estate holdings. And the way to do that is to tap into the equity, the rich equity that they still have in spite of the fact that prices are coming down and more loan officers are starting to do more investment loans. That's why you really need to kind of brush up on your investment properties. And I'll tell you this right now. I actually was speaking about a deal a couple of days ago, a DSCR deal, and I had it with an A-paper lender. And the A-paper lender had the price, I think it was 7 1/8 at 1 5/8 cost. That was because of where our DSCR was at and all that type of stuff. But I moved it over to, we moved it over to Oak Tree, and we got that same rate with 2.5 rebate. And the moral to the story is this, is when we're looking at some of these investment properties, we need to be fluent in the language of non-QM, don't we? We have to know who offers the best prices on the best rates for the best programs out there so we can truly be full-time professional loan officers. And it might surprise you that on a lot of your investment properties, you're going to find better pricing with our non-QM lenders. Again, my friends over at Oak Tree, just reach out to Oak Tree. They'll have a conversation with you about some of their investment properties, and you might, again, find better pricing there. But 7 1/8 paying 2.5 back on a DSCR deal, something like that, is a remarkable deal. And, so if we're going back to our past client database and you figure you have your clients who've been in their property for, let's say, 4 to the last 10 years, they're sitting on a significant amount of equity. If we want to pull on that equity in order to buy another property using DSCR, it becomes a very simple tool in order for you to get people in. You will absolutely get the cash out on their primary residence, that ton of equity, and then you could go ahead and use that to put them in a DSCR loan or a full doc loan, whatever is going to price better for your consumer. But even if you're going down the road of a DSCR, you might even be able to get, with how rates are going right now, somewhere maybe even below 7s. Again, don't quote me on this because they're not my loans. It's just some of the pricing that I've seen out there. But for loan officers, very, very important to check with your non-QM lenders out there because they might just have better deals on your investment properties than you're going to find with your typical agency meat and potato, Fannie, Freddie, Jenny type of loans. Fannie, Freddie, really, not Jenny. So these are all great things that are taking place in our market right now that are helping loan officers close more transactions. And that's why we saw that our June numbers when it comes to sales are up above expectations are on the street. And we can expect that trend to continue going forward. Another component for loan officers and real estate agents that I really need you to understand here is quite simply this. The fact that you're still writing loans right now is actually helping you. The best marketing that you have is existing and occupying the space as a real estate agent or a mortgage loan officer. Why do I say that? Well, if we've lost 40% of real estate agents, 30% of real estate agents, and 30% of loan officers, that means you simply have less competition for the same amount of business, regardless of if they're here or not. So if we have 30% fewer loan officers vying for the same amount of business, you should be picking up market share by just doing whatever it is you're doing now. Now, if you really want to do something fantastic, jump over with us with Cap Direct, where we crowdsource and hold everybody accountable to what their numbers and figures are to stay in front of all these changes. But if you were to go and really focus on your business right now and get your stuff in order, as the market begins to change, you can actually pick up a disproportionately large portion of your business, taking off some of the leftover competition, and you could be sitting this time next year with a business and a bank account that makes you proud. Remember, it's what we do today that's going to make Christmas great for your kids. Finally, the other thing that's really helping us out, before I get into what the great story is, what's helping us out is what's taking place over at the Fed right now. We're not worried about the Fed meetings anymore and having them raise rates anymore, right? Now, what we're looking at is a steady Eddie where rates really aren't moving, but any expected moves by the Fed is to bring the Fed fund rate back down. Now, even though it doesn't have a direct correlation over to mortgage interest rates, it certainly does have some impact on it. But when the Fed fund rate goes down, what it's going to do is lower, our credit card debt. It's going to make those car payments for any, future purchases on cars. Don't buy cars. Any future purchases on cars. It's going to bring those interest rates down. And it's also going to bring the interest rates down on all the HELOCs that we have done and the HELOCs that we are going to do. All of these things affect our debt to income ratios, which has really blown everybody out of the water. So when we add that equation into all the things that I just told you, yeah, this is shaping up to be a good market. We're not going to get there overnight, but we're going in the right direction. So again, right now, while we have time to lean, we have time to fix our business and get best practices in order. Again, one of the things that we do over here at Mortgage Shots and Cap Direct is I run a sales book club on Wednesdays at 12 o'clock Pacific Standard Time. Now, if you as a loan officer or a real estate agent want to be a part of my book club as a means of trying to get our business back on track and kind of get your mind right, as I said in Cool Hand Luke, you can certainly go ahead and do it again. Just send me an instant message and I'll make sure that I get that link over to you. I'm not charging doing anything for books. Frankly, I get a lot out of reading our sales books. We're reading Atomic Habits right now. I have a great presentation that I do on this, and we apply it to our origination business, so it's applicable to exactly what we do. And the numbers are bearing it out that it's helping people. Again, there's no cost of money to you, and because of that, I think what happens is some people say, well, there's not a value if there's not a cost associated with it. No. There is a cost to you. The cost is this. It's your time and your intellect. You've got to actually pay attention, and you have to really kind of constructively look at your business and participate with a group. And if you've got that, then you can network and meet loan officers and realtors around the country, and you can certainly be a part of our book club. But again, all you have to do is send me an instant message here on Facebook or leave me a message in the comments down below. It's been really fun to dust it off and start with books again, and I look forward to hopefully seeing you. Now, what I'm going to do here, guys, I'm going to screw around on my screen for a second. I'm going to go into a short little presentation that I have. Okay, so what we're talking about is quite simply this. FHA, they have what I believe to be a little clandestine mission, what they're doing with their MMI, their mutual mortgage fund account that they currently have. And what they're doing really flies into the face of logic as we see it today. And I believe that the only conclusion that we can draw from this is that FHA sees things on the horizon similar to what I see, and they expect to see a tidal wave of tsunamis. I hate these metaphors, but that's what they call them. A tidal wave of foreclosures are coming our way, and before we fret that a tidal wave of tsunamis is going to be a bad thing, it certainly can be for the folks that are living in the houses, but when it comes to the health of our country, because when you're not making your house payment, you're not paying your tax bill, which means we're underfunding our cities. When we get people into these homes who are actually paying their tax bills and getting their insurance, we're going to rejuvenate our communities, and this is a way to kickstart not only the real estate and mortgage lending industry, but really kind of kickstart our economy going in the right direction. So I'm looking at this kind of like a forest fire that we're suffering out here in Northern California. One of the things with forest fires, though they tend to be bad overall, is they are required for the health of the overall forest. Right now, what we have is we have an opportunity by what's going to come, if we were to believe what I think FHA is thinking, that we're going to have a lot of foreclosures in the future, at least with their book of business, which presumably, if we were to look back at 2008 and other recessions that hit the housing market, it's going to have an effect on all books of business, including our non-QM and our Fannie and Freddie book of business as well. But I'm going to keep this specifically over to the FHA. Okay, so here's what FHA put out. Now, what I want you to do is I want you to note the dates on this. This is a press release that HUD, who has jurisdiction over the FHA, they put this out on July 17th, 2024, just a couple of weeks ago. Now, I don't think a lot of people really looked at this because it didn't seem terribly interesting, did it? Now, what it is it's HUD's new proposed rule to govern the sales of FHA mortgages. Now, the proposed rule is to establish a permanent single-family residence program, including exclusive first-look opportunities for prospective home buyers. What they're doing with this program is they're trying to protect their mutual mortgage insurance fund account. Now, your mutual mortgage insurance fund, it's basically you have your financed and your upfront MIP, don't you, on an FHA deal. We have two forms of mortgage insurance on an FHA loan. When that money is paid, very similar to Fannie and Freddie's G fee, that money then goes into a separate account. Now, that separate account with all this mortgage insurance money that's going into it is used in the event of foreclosures. That's the key that you need to understand. It's used in the event of foreclosures. So if somebody is going to purchase a mortgage-backed security, and then you're going to have somebody who is servicing that FHA mortgage-backed security, what's going to happen is that servicer is guaranteeing whoever the investor is going to continue to get their payments, right? In the event that they don't get their payments, well, then that servicer is going to go through a foreclosure process on it. And then the idea is the cost of those missed payments and the cost of that foreclosure, all the legal fees and everything that entails, upwards oftentimes up to $100,000 in fees, is going to come out of the proceeds from the property. And then the proceeds from the property will make that servicer and that mortgage-backed security note holder whole again. In the event that there's not enough money on the table to cover these fees, all of the fees on that mortgage-backed security, well, then what happens is they go over to FHA, and FHA reaches into the mutual mortgage fund account, and they make sure that that servicer and that note holder on that FHA mortgage-backed security are whole. Okay, that is the implicit guarantee from the government that we have on our Fannie and Freddie deals, and it's also the implicit guarantee that we get from HUD. So the government is just guaranteeing as a backstop that whoever's investing in mortgage-backed securities isn't going to find themselves screwed and upside down. Now, back in 2008, this became something of a problem for Fannie Mae and Freddie Mac, which is precisely the reason why they find themselves in conservatorship today. Their GP account, to offset the cost of foreclosures, was not large enough to cover the number of foreclosures that we had back in 2008. Now, the reason for this is kind of multifaceted, and I don't want to get in the weeds on this, but one of them is the government was actually taking that money from that account, the GFI account from Fannie and Freddie, and they were reallocating it to things that had nothing to do with mortgages. Kind of like what they're doing with Social Security right now. So one of the big stories that I tell is some of that money was actually used to clean up the BP oil spill in the Gulf of Mexico. If you remember that a number of years ago when that spout came up and all the oil was coming up out of the ground and it just basically killed everything in the Gulf of Mexico, well, our government had to pay for a lot of that. Where did they get the money? They took the money from Fannie Mae and Freddie Mac and they used that to clean up the Gulf of Mexico. That means so anybody who was getting a 30-year fixed rate mortgages during those years, you got to finance, in part, the cleanup of the Gulf of Mexico with your mortgage. If it seems a little crooked to you, well, it seems a little crooked to me too, yet that's exactly where we're at. So they left them undercapitalized, and what happened with the 2008 meltdown is they found themselves in a situation where they didn't have enough money in their account. They had to take a bailout, and they've currently find themselves in the longest and largest conservatorship in the history of the world. Now, that conservatorship that they are still in to this day is the longest one in the history of the world, and the only one that it's beating out, and this is crazy, but it's true, and we live in a crazy world. It just last year passed Britney Spears as the longest conservatorship in the history of our country. Is that not crazy? What does Fannie Mae, Freddie Mac, and Britney Spears have in common? Well, there's the answer to that trivia question, or one you might want to pose to your real estate agent friends out there. In any event, no director of any government agency wants this on their books. And so what's taking place right now is we see HUD coming out via their FHA with this new proposed rule out there, which is designed to go ahead and protect and preserve their mutual mortgage fund, insurance fund account as we see it today. Now, that on the surface doesn't seem like a really big deal, and it's not if you don't know the backstory, and more importantly, if you don't know where they're currently at. I want to read this to you. The program requirements which in the proposed rule are intended to ensure the program meets its dual purpose. There's a dual purpose for this new proposed rule to manage HUD's fiduciary responsibility to the Mutual Mortgage Insurance Fund. Their fiduciary, their legal obligation is to protect their MMI account. So this proposed rule stands to reason that they would do anything that they could do to protect it. So right now, nothing sounds out of the ordinary. It's the second part that we have to look at. While encouraging mortgage loan amounts that are consistent with our mission, well, their mission over at HUD is to serve underserved communities and low to moderate income communities. That is their mission statement. This is what they are tasked to do. Now, let me ask you this. If you are an underserved or a low to moderate income community right now, can you afford to buy a house in your community? The answer is emphatically no, and I don't care if you live in Mississippi or North Dakota or anywhere in between. The reason is when we're looking at the median income sales price for a house across the country right now, it's north of $400,000. When you look at the median income for those communities, for many communities, just communities all across the country, the median income cannot afford to buy the median house. So if you're below the median and you're a low to moderate income family or community, your chances of buying a house in your community are absolutely dead in the water right now, by and large. Now, there's programs that exist that might be able to help you out, but not really fulfilling the mission statement. So one would think if FHA is sitting on a boatload of money that far exceeds what they have to keep in their mutual mortgage insurance fund account, that what they would do is they would take that money and they'd say, okay, we're going to go ahead and put ourselves a little bit over the chopping block here. We're going to lower the mortgage insurance on FHA loans, which will lower the payment on FHA loans, which will get us closer to fulfilling the second part of our fiduciary, which is helping low to moderate income families in underserved communities. That seems to be logical. Now, I had these conversations with Dave Stevens before he passed away for years and years, and he was the one, and he, by the way, is the past president of the FHA. Now, he had said a number of times that he truly believed, he goes, you can count on it, FHA is going to lower their MI. Well, we really haven't seen that now, have we? Why is that? Why have we not seen them lower it? Now, going back to the first part of this mission statement, their fiduciary, which is to protect that mutual mortgage insurance fund account. More on that in a second, and we'll get to what our conclusion is and what you need to do. The proposed rule would also enable HUD to continue prioritizing awarding these mortgage loans to nonprofit organizations and government entities that provide guidelines for direct sales of notes to such buyers. Okay, so in the event that they're going to have to pay out and they're going to have to take ownership of some of these properties, which is attacking their mutual mortgage insurance fund account, what they're saying is we can go ahead and we can give these to government agencies or nonprofits, and we can go ahead and sell these properties to underserved communities fulfilling the first part of their fiduciary. This feels a little how shall I say it, expedient for them to do, considering what their next move is and what I'm about to tell you. This right here is we're looking at the Department of Housing and Urban Development's Office of Housing FHA Mutual Mortgage Fund Insurance account. Their MMI account has insured approximately 53.7 million mortgages across the country. Fannie and Freddie are the big guys on the block, but they have insured over 53 million homes. Times that by an average of, say, $150,000, $200,000 loan amount, then how much do they have insured? They don't have billions, my friends. They are in the trillions in terms of what they have insurance on. Their book of business is wildly huge. FHA also remains active and viable in all markets during times of economic disruption, playing an important and counter-cyclical role until private capital returns to its normal levels. So what they're saying here is that FHA becomes of paramount importance during times when private capital wants to stay out of the game, and this is something that we've seen in previous years. Now, the anticipation is that private capital might come back to the market. Now, their budget, you need to ask yourself, of their mutual mortgage insurance fund account, how much money are they pulling out of that for their operational budget? Now, their operational budget includes $400 billion in loan guarantees commitment authorities. Their budget includes $400 billion. Now, their budget is their $400 billion that they're talking about here is the money that they've got earmarked for in their MMI account in order to pay these foreclosures off. The truth of the matter is the amount is more than $400 billion. Now, I want you to pay attention to this slide here because I think this one is super, super important. The Federal Housing Administration, FHA's Mutual Mortgage Insurance Fund account, their MMI account, is required by law to maintain a capital ratio of at least 2% of its total insurance in force. So Congress says if you're going to give your guarantee, Congress requires, this is kind of like the Basel III rule that is being bantered about right now, the same idea, or like any bank, you have to have so much funds on hand if you're going to offer this type of insurance up. Congress has said FHA has to keep a congressional mandate of 2% of its entire portfolio cash on hand in their MMI account so they can deal with foreclosures even if a large wave comes. Back in 2008, they were actually significantly below 2%, and that's why they actually raised their mortgage insurance on FHA loans at precisely the wrong time, according to me, yet that's exactly what they did. So now we have bloated mortgage insurance. We have, they were below their 2% congressional mandate. I guess we need to ask ourselves, where are they at right now? If they needed to get to 2% in 2008, where are they at right now? Well, let me ask you this. How many foreclosures have taken place since the 2009 and 10 when we kind of righted the ship? And again, getting back to the whole idea of superlatives, we have record low foreclosures. Well, if we have record low foreclosures and we're capturing all this mortgage insurance money, our upfront and our finance mortgage insurance, that means that our MMI account has been doing nothing but growing. Now, on the left-hand side, kind of over in that raspberry color, what I have highlighted with the arrow, I want to read this. It says, the FHA today released its annual report to Congress that shows the agency's capital reserve ratio of its mutual mortgage insurance fund account. Their MMI account ended the fiscal year of September 30th, 2023 at a whopping 10.51%. Now, it's a slight decrease of only 0.6% from the previous year. So FHA, if you're doing the math on this, has a congressional mandate of holding 2% of their funds in their MMI account, and they've got a whopping 10.51%. They have more than five times the congressional mandate of the amount of money that they have to have in that account in order to meet Congress's mandate. That comes out, by the way, to $491 billion, $500 billion. They've got Bill Gates and Elon Musk money right now. Combined, they have an enormous stockpile of cash. That's why when you're looking at what's taking place with FHA right now, their MMI account, and when you consider the massive unaffordability that we currently have in housing, and you consider that the second half of their fiduciary is to serve underserved communities, what they should logically be doing right now is lowering mortgage insurance to lower payments to get closer to that fiduciary to serve underserved communities by bringing mortgage payments down. In fact, if you really are to kind of look at this whole thing, this is what we're hearing from the National Association of Realtors. This is what we're hearing from the Mortgage Bankers Association. This is what we're hearing from the National Association of Home Builders, is that NAR and all of the other groups say that the mortgage insurance on our FHA deals should go down to help affordability. And by the way, according to the National Association of Realtors, could save a massive 850,000 consumers with FHA-backed mortgages. this seems like it would go a long way to fixing some of the problems that we're facing right now. Now, with lower sales prices, with lower interest rate, with more concessions where you could buy down a rate, and if you were to add to that equation what logic dictates FHA should be doing by lowering their MI, you might actually get to some of these low to moderate income families to where they could realize the dream of home ownership. Not only is FHA not doing that, they're going exactly in the opposite direction, proposing a rule right now which would put the onus of responsibility to pay some of these on the mortgage servicers and those who own the mortgage-backed securities. They want to do as much as humanly possible through this proposed rule to protect their bloated 10.1%, $491 billion MMI account, and I guess that would be to make that amount larger than what it currently is. That's what they're getting pressured to do. That's what logically they should be doing. That's what they should do to fulfill their fiduciary and their mission statement, but they're doing the opposite. They're doing the opposite right now. That's why when I saw this, I kind of started to scratch my head. So I want you to ask yourself, why on earth would they do this? Why would they do something that seems to fly in the face of logic? Well, here's what I think. Here's the only thing that I can tell that makes sense. And if you know something that makes sense or you have any questions, put them in the comments down below and I'll make sure that I answer those. But the only thing that makes sense to me is FHA and HUD, very much like Fannie and Freddie, they know something that we don't know. Now, what is it that they know that we don't know? Well, I think it's something like this. Again, HUD has the greatest economists the world has ever known. They do. Just like Fannie and Freddie, the highest educated economists, the greatest economists, they have the same backdoor access to the Fed, the House Financial Services Committee, the Senate Banking Committee, to the White House, to Congress, to the GSEs, to the Treasury, to everybody. These are the groups, the entities that are dictating policy. These are the ones that are kind of looking at what's taking place and making changes that is going to be in our country's best interest, presumably, right? So I think if you accept the fact that they have got better prognosticators than we have, that they are looking at their future. I think the current director is looking at what took place in 2008 and 9 with the FHFA, with Fannie and Freddie, who are still to this day in that longest running conservatorship in the history of the world, and saying, not on my watch this is going to happen. I believe that they're looking at the immediate future and saying, we are going to have what really amounts to a tsunami of foreclosures in our near future, and these foreclosures are going to tax our even bloated $491 billion MMI account that's sitting at 10.51%. I think that they're so concerned about this, that they're so concerned about going down below the congressional mandate, that they're so concerned about taking a bailout, that they're doing everything they can to keep every dollar they currently have so they can ride out the storm. Because nothing else at this point makes sense to me as to why they would do this. Now, they've had this as a pilot program for a number of months, but they're trying to make it the law of the land. And I think they're doing it because those dark clouds that they have in front of them are getting closer and they're getting darker. I think that FHA and HUD right now are battening down their hatches. Again, it's the only thing that makes sense if they're doing something that flies in the face of logic right now, is they know something we don't know, and that is a tsunami of foreclosures that's in our near future. Now, the question you have to ask yourself as a mortgage loan officer or originator, and I kind of alluded to this earlier, is this necessarily a bad thing? And I say emphatically it's not. Well, how can you say that? Well, because if new home builders aren't going to build the homes that we need in order to get, affordability back on the table, well, then something has to happen to create that inventory that we need for people who can, ready, willing, and able to buy houses, make their payments, but more importantly, pay the tax bills, especially for some of the smaller communities that so desperately need that tax base to keep the schools going, to keep our first responders paid, to keep our roads, decent. This money is vitally important to the lifeblood of our entire country. If we are going to see a wave of foreclosures, understand this isn't a judgment of good or bad. This is simply pragmatically, it's either going to be or not going to be. And as a professional mortgage loan officer and real estate agent, we have to say, okay, how can we position ourselves, frankly, to help? Now, how we can help is write loans, write good loans, write clean loans, and write loans at great rates for these clients. And the better and the faster and more efficient we could be at our job, the better we can get through what I think HUD and the FHA sees as a problem that's going to be, basically on the horizons for everybody. Now, again, I'm not downplaying the negativity of this. I'm just saying that there's a real opportunity for loan officers out there and real estate agents to go out there and shine if this, in fact, is the case. Okay, so if we're going, because people who are going to buy houses are going to need to borrow somebody else's money, and that's where we come in. Somebody's going to have to list that house. Somebody's going to have to sell that house. Great time to take away buyer side commissions on transactions. Would it be great to have a fleet of real estate agents out there ready to service all these clients who might be looking at a bunch of foreclosures? That could make 2008. It could be similar to it, bigger or smaller. We don't know that yet. But FHA's move seems to be a little bit extreme to me. So what does that mean? Well, if you're a mortgage loan officer, it's quite simple. If we've got 30% fewer real estate agents in the industry right now, it is vitally important that you work with more agents right now than ever. Because as I told you, your business is improving through attrition alone. You don't have as much competition, and the same holds true for real estate agents. The ones who are left standing still writing loans are going to be basically your top 70%. We'd like to get the top 10% or top 20%, but top 70% is better than a top 100%. So right now as a loan officer, while things are still relatively slow, this is a great time for you to reach out to your database of real estate agents and really go above and beyond the call of duty when it comes to service. Go out there, have your conversations, meet with them, collect real estate agents like baseball cards. I'm not objectifying you agents, but loan officers, you should be going out there and really kind of assembling your team for a game that's going to be played, that is going to be very clearly defined by those who win and those who don't. Now, I've said this in the past. Nobody learns anything in a good market. All the lessons we learn are in bad markets. And hopefully through the last couple of years, we've learned a lot of lessons. But you see, we're not done yet. We haven't even hit the eye of the storm yet. There's more lessons in front of us that we're going to learn, and we can either learn them the easy way or we can learn them the hard way. Now, if you don't know which direction you're going, if you don't know what's the easier or the hard way, reach out to me. This is stuff that I look at. I've looked at for nearly 20 years now, and I have a pretty good idea what I'm going to do and what I think that we should be doing. But more importantly, my opinions are better when they're paired with your opinions and others' opinions who are thoughtful about their business and concerned about where their production is and the direction that they're going about your business the absolute right way. If this is you, reach out to me. Like I said, send me an Insta message or leave a comment down below and let's have a conversation about this. But very easily, and just kind of low-hanging fruit is start working with more agents, reach out to them. Listen, if you're not closing 10 deals a month, you certainly have time to do this. Reach out to those great agents right now and start putting your plan of attack together. Because if my belief of what FHA is doing is right, what HUD is doing is right, if this is true, and if this is in fact what is going to happen, well, then having a great team before the storm hits is a hell of a lot better than putting that team together midway through the storm. This is what we're doing over here, and we're looking to build and grow with our team. So let me know. Tell me what you think about what I shared with you today. I hope this was helpful for you, and this is certainly fun for me to bring this to you guys once again. With that said, you guys make it a great day. Happy selling, and we will chat hopefully mañana. Au revoir.